If you're interested in becoming a profitable trader, then understanding the concept of supply and demand is absolutely crucial. At its core, the price of an asset moves because of supply and demand zones. By understanding the underlying forces that drive supply and demand, you'll be better equipped to make informed trading decisions that can help you maximize your profits and minimize your risks, allowing you to become a profitable trader. So if you're ready to take your trading skills to the next level, then make sure to watch the full video. To be able to trade using supply and demand zones, it's important that we first have a correct understanding of what a supply or demand zone is. A demand zone is a point in the market where there is a lot of demand. This is usually caused by big institutions or banks placing a large number of buy orders at that price zone. This causes an imbalance to be created, which will result in the price suddenly and aggressively moving to the upside. A supply zone is usually formed when banks or big institutions place a large number of sell orders at a particular price zone. This will cause for the price to aggressively move back to the downside when the price reaches the supply zone. So, supply zones are created when there is an excessive supply or selling pressure at a particular price level, and demand zones are created when there is an excess of demand or buying pressure at a particular price level. Now that we know exactly what supply and demand zones are, let's take a look at how to spot these zones so that we can profit from them. In order to spot a demand zone, traders typically look for a downtrend in the market, which is characterized by a series of lower highs and lower lows. When a large amount of buy orders are filled in the market, this can cause the price to make a sharp move to the upside. We can spot this by looking for a large green candlestick on the price chart, which is often accompanied by small or no wicks. This large green candlestick represents the point where buyers have overwhelmed sellers, leading to a significant upward movement in the price. To draw the demand zone, head over to the toolbar on the left and click on the box tool. Now let's draw a box around the high and low of the candlestick that will represent the demand zone. When you have done this, extend the box into the future to identify potential areas of support. To spot a supply zone, we will need to look for an uptrend in the market. We can see that an uptrend has formed here due to the higher highs and higher lows. To identify the supply zone, we will be looking for a large red candlestick. This candlestick shows us that there was an aggressive move to the downside. Now that we have spotted the candlestick, let's draw a box around the high and low of it and extend the box into the future. Even though this is the most common way of identifying supply and demand zones, let's take a look at different methods that are also commonly used. For this method, we will need to enable the horizontal grid lines on TradingView. To do this, right-click on the chart and click on the Settings tab. Then click on the Appearance button. Here we will be enabling the horizontal grid lines and making them more visible by increasing the opacity. That was all that we needed to do. Now you can exit out of the settings. This method is used for spotting psychological supply and demand zones. By adjusting the chart, we will eventually see that there are certain lines that the price frequently rejects. This is because retail traders like placing buy or sell orders at whole numbers. This causes for certain whole numbers where an excessive amount of retail traders placed buy or sell orders to become supply and demand zones. If you see that the price frequently bounces of a particular whole number price point, then excessive retail orders will usually be the cause. Now that you know exactly how to spot supply and demand zones using two different methods, let's take a look at an example of a buy entry that can be made using supply and demand zones. But before that, if you are looking for a broker that has extremely low commissions and spreads, then check out Henko Trade. The best broker to trade forex, indices, commodities, or crypto. They have live chat support so that any questions you may have can be quickly and easily answered. One of Henko Trade's most prominent promotional offers is the matching deposit bonus that can be claimed when you open an account with Henko Trade. Sign up via the link in the description to register with Henko Trade and get access to all of these perks. We are currently looking at BTC/USD on the 1-hour timeframe. We see here that the price got close to and rejected the $15,600 price level. If we look back, we see that this happened before, indicating that there are a lot of retail buy orders at this zone. If we look at the price action, we also see that a downtrend was playing out. We know this because we can see that the price was making lower lows. However, this downtrend was broken by a large green candlestick. If we take a closer look at the candlestick, we also see that the candlestick has short wicks, making it likely that banks and big institutions also have buy orders at that price level. This means that this is a valid demand zone. Let's now draw a box around the high and low of the candlestick to visualize the demand zone. Once you have done this, make sure to extend the box into the future. Now we will wait for the price to reach the demand zone again. As you can see, the price reached the demand zone here. Now let's switch to the 15-minute time frame to find the exact point at which we will enter into the position. On the 15-minute time frame, we see that the price indeed reached the demand zone. To make sure that we only enter into a position if the price rejects the zone, let's first wait for the price to break out of the demand zone. We see this happening here. Now that all of the conditions have been met, let's enter into the position. We will be placing the stop loss slightly below the low of the demand zone. We do this to avoid getting wicked out if price decides to fill the demand zone first. For the take profit, we will be targeting a 1-to-1 risk-to-reward ratio for half of the position. This means that we will exit with 50% of the position at a 1-to-1 risk-reward ratio. Now let's see how the trade plays out. We can see that our first take profit target was hit. Our new take profit target will be for a 2 times risk-to-reward ratio. However, it's also important to first lock in some profits. So let's now move the stop loss to break even to avoid making a loss if the price were to reverse again. Now let's see how the trade plays out. Here we see that the price rejected the $30,600 price level. If we take a look at the past price action, we can see that this has happened before, making it likely that there is a psychological supply zone at this price level. If we take a look at the price action, we can also see that an uptrend was playing out because of the price making higher lows. We can see that the uptrend was broken by a large red candlestick with very short wicks. This also indicates that there is a supply zone at that price level. So let's draw a box around the high and low of the candlestick and extend it into the future to visualize the supply zone. Now let's wait for the price to reach the supply zone. As you can see, this occurs here, so let's now switch to the 15-minute time frame to pinpoint the exact price at which we will enter into the position. On the 15-minute time frame, we can also see that a short-term uptrend was playing out. Before entering into the position, we will need to make sure that the price closes outside of the supply zone. We see that this occurs here. Now that all of the conditions have been met, let's enter into the sell position. To prevent being stopped out in case the price fills the supply zone first, we will set the stop loss just above the high of the zone. For the take profit, we will be exiting with 50% of the position at a risk-to-reward ratio of 1. Now let's take a look at how the trade will play out. As you can see, the first take profit level was hit. This means that we can now target a 2 times risk-to-reward ratio for the remaining amount of the position. After doing so, we will also set the stop loss to break even. Now let's see how the price action will react. As you can see, the trade was very profitable. I hope this video could demonstrate how supply and demand zones can be used and integrated into a strategy. If you enjoyed the video, please leave a like and subscribe to the channel. If you have any questions, feel free to leave a comment.